And Martin Crabb from Shaw and Partners joins me now, and for the first time in 2023, mind you.
Yeah, is it too late to say Happy New Year?
Mate, say it. You know, bring the jolly, because, well, I suppose for a lot of people out there, it hasn't been too jolly, at least if you have a mortgage or perhaps an investment portfolio, because it was a bit of a surprise, a little bit of a scary RBA perhaps.
Yeah, the language really caught the market by surprise. The decision didn't. Everyone had 25. There was some talk of 40, but that was never going to happen. But it's the plural rate hikes. There will be more rate hikes. So a lot of economists bunched around 3.6 as peak cash rates, which is 25 higher than where we are. That's not plural, that's singular. So we're at least 3.85, maybe we're 4.1, you know, we're certainly higher. So the futures, you know, today, these are the SFE futures 370. I think the overnight interest rate swaps up to 380. So you're starting to see what was going to be 3.5, 3.6 peak cash is now pushing up closer to that 4% level, which has scary implications for the economy because that's going to crater the housing market further. It leaves any hope for a soft landing kind of one side, and it's a surprisingly hawkish tone from a central bank that's been kind of not neutral, but a little bit more balanced. We've sort of almost got used to the Fed being hawkish, but the RBA being a bit more balanced. But that suggests that they don't think the job's done on inflation. They still think the economy's strong, and they think there's more work to do. And they don't want us market participants getting carried away with our 7% rise in the equity market so far this year. What are we thinking?
No, absolutely not. Not good for financial conditions by any means. But let's look at some of those areas of the market that could be sensitive, and consumer-facing stocks will obviously be under the microscope.
Yeah, it's been really interesting, Kyle. The ABS statistics, which have some bizarre seasonal adjustment factors to them, suggested retail sales were terrible in December, department sales down 15%, seasonally adjusted. But Myer reported record profits, JB Hi-Fi reported record profits, Super Cheap Auto reported really good results. And so we kind of came into the new year with this narrative that the consumers, put their hand in the pocket over Christmas and had a pretty good time. In the last 24 hours, we had Nick Scali and ARB Corp, which are both consumer-facing businesses, slightly different because one's furniture and the other's, car parts. Both stocks absolutely butchered. I mean, ARB's down 15%. Nick Scali was down 15% yesterday. So yes, these are market darlings and they're high PE stocks. They're a little bit vulnerable to a downgrade, but the tone's changed almost 180 degrees in just a few days. We've gone from having upgrades and everything to a couple of downgrades. So it just shows how fickle the market is around these retail stocks.
Yeah, I was taken aback by the fact that consumer discretionary in January was the second best performing area of the market. I think after materials, which was a no-brainer after the China element. But let's talk asset allocation here, because interestingly enough, you have said you've shifted underweight equities to neutral, which I mean, sort of seems like maybe that's the general gist of the market right now, isn't it? That there was a lot of bearishness coming into the new year, and we've just seen this marginal shift back into equities that has been largely responsible for what has been a pretty good start to the year. Yeah,
I mean, everyone has the same playbook. They've been looking for the interest rate hikes to start biting the consumer, and at some point this year, there's going to be a cliff, and everyone's expected the cliff to happen in November, December, January. It hasn't really happened. So there's a lot of people who are short consumer names and cyclical names who've kind of gone, well, why are we down, so far? These stocks are probably not as bad as we think. So hence, when you get those early upgrades coming through in those consumer stocks, caused a lot of short covering. From equity positioning, we know from the fund manager surveys, but also the managers that we talk to on a regular basis, people are cashed up and people are still pretty cautious on growth assets. They are waiting for this recession to happen, and they think earnings estimates are too high, and they're going to wait for these earnings estimates to come down, and then they can reprice equities at a lower level. I think the market's already positioned for that, so it's a bit like playing a game of cards. You've got to look at what your opponent holds as well. The market's very short and very cautious and very bearish, and therefore any good news, people have to short cover. So we think markets don't look outstandingly cheap. The TSR in the Aussie market's about 6%, which is not great, but it's better than sitting in cash. So we just think that investors are best off being in their long-term asset allocation right now with no real major differences from the long-term policy. Be fully invested, participate in markets. Yes, there'll be a little bit a bump like we have today, but generally speaking, sitting out of the markets doesn't make sense unless you think they're going down. and it's difficult to see a case for big downside in equities from here.
Just one final question on just some of the bigger players, because I guess this has been one, contrarian play that a lot of people have been throwing about, which is, the likes of BHP and both CBA being at record highs, which you would think implies a lot of positivity about the future. I mean, when it comes to the broader market, obviously you can sort of shift yourself to position away from that and be less exposed to it. But does that sort of suggest that maybe there's a lot of optimism sort of baked into the market currently about both the China story as well as the outlook for the Australian economy this year?
Yeah, I mean, I think they're two interesting stocks. They make up about 20% of the market between them, and throw in CSL, you're almost at 30%.
There, yeah.
But those three big stocks. The phenomenon we've seen here, like we have around the world, is the mega caps are getting most of the flow. So there's this big divergence between the valuations of the very large stocks and the rest of the market. So talk to any small or emerging cap manager, and they had a really tough year last year, despite the fact the market wasn't too bad. So I think you can get a little bit misled by the valuations on the big cap stocks, and there's certainly lots of value out there. But I mean, they're playing different narratives. The CBA is obviously a soft landing. The housing market is the air's getting let out of the tire, but no one's defaulting, so they'll be okay. BHP is obviously a recovery on China. So there's different factors, micro factors driving these stocks. But generally speaking, you look at the valuation of large caps over small caps, there does seem to be a bit more value in the small end of the market.